All right, let's talk about one of the most powerful tools in any trader's toolkit, the simple trend line. But here's the thing, it's also one of the most misunderstood and misused. Today we're going to change that. We're going to build a complete blueprint for how to use them not just correctly, but profitably. Let's dive in.
I mean, it seems so basic, right? You're just drawing a line on a chart. But that simplicity, it's really deceptive. The biggest point of confusion, the one that trips up almost every single trader, is figuring out what that line is actually telling you to do. And this is the fundamental dilemma. Do you buy when the price touches the line, betting it's going to hold and bounce, or do you sell when it breaks through, betting the entire trend is about to reverse? I mean, those are two completely opposite actions, and you can see how choosing the wrong one is just a recipe for disaster. But don't you worry, today we are going to give you a clear, rule-based blueprint for handling both of these scenarios.
But listen, before we can even think about trading them, we have to know how to draw them the right way. Any profitable strategy is going to fall apart if the foundation is weak. And when it comes to trend lines, that foundation is knowing exactly where to place them on your chart. Get this part wrong, and nothing else matters.
It all starts with something called a swing point. Just look for those really obvious turning points on your chart. You know, the peaks and valleys where the price clearly slammed on the brakes and changed direction. These points are our anchors. They are the fundamental building blocks we're going to use to construct our trend line. Okay, now for the classic debate. Do you connect the wicks of the candles or do you connect the bodies? The answer is actually way simpler than you think, and it's not some rigid, always do this rule. Here's the key. You use whichever method gives you the most touch points. It's that simple. In this example, connecting the bodies gives us 5 solid touches, while connecting the wicks only gives us 3. So for this chart, connecting the bodies is the clear winner. Now this right here is a massive mental shift, so pay close attention. You have to stop thinking of your trend line as this razor-thin, exact price level. It's not a laser beam. Instead, you've got to think of it as a broader area, a zone of support or resistance. This little change in perspective gives the price room to breathe, and as you're about to see, it is the secret to not getting shaken out of a perfectly good trade by minor little fluctuations.
All right, with our lines drawn correctly and our new zone mindset locked in, let's get into our first actionable strategy. This one is all about trading those high probability bounces, but, and this is crucial, with a confirmation filter to keep us out of the bad trades.
This is exactly what we want to avoid. The amateur trader, they see the price touch that line and they immediately smash the buy button, just praying for a bounce. But look what happens. Without any real confirmation, the price can just slice right through that line like butter, leading to an instant and really frustrating loss. We need a better way. We need to be more patient. And here is that better way. It's a simple 3-step checklist. First, we wait. We patiently wait for the price to enter our trendline zone. Second, we glance at our confirmation tool, the stochastic indicator, which is just fantastic for measuring momentum. When it crosses down into the oversold area, it's telling us that the selling pressure is getting exhausted. But here's the trigger. The actual entry signal is step 3, when that stochastic line crosses back inside. That's our confirmation. That tells us momentum is shifting and the buyers are finally stepping back in.
Of course, no strategy on earth is complete with some ironclad risk management. The rules are super simple. Your stop loss goes just below the recent swing low. Easy. For your take profit, you're going to target double the amount that you're risking. This 2-to-1 risk-to-reward ratio is absolutely key for staying profitable in the long run.
Okay, let's switch gears and move on to our second strategy. This one tackles the other side of the coin. How do we identify a genuine trend reversal? And more importantly, how do we avoid getting burned by all those frustrating fakeouts?
And this picture right here illustrates the exact problem we're trying to solve. You've seen this happen, right? Price breaks the trend line, you jump in short thinking, this is it, the trend has changed, and then, boom, it snaps right back in your face, stopping you out for a loss. That is the costly fake out, and our next set of rules is designed specifically to filter these out.
The secret is to learn how to read the health of the trend itself. You see, in a strong, healthy downtrend, the price is going to consistently make new lower lows. Each dip goes a little bit lower than the last one. This is the market telling us that the sellers are still firmly in control, and it is not time to be looking for a reversal just yet.
But then, this happens. The price tries to go down, but it fails to make a new lower low. Instead, it forms what we call a higher low. Now, this doesn't mean the trend is reversed. Not yet. But it is our first critical clue that momentum is shifting. The trend is getting tired, it's weakening, and this is when we start to pay very close attention.
So, here's the checklist for a true breakout trade. Step 1, and this is the most important part, happens before the break. We need to see that market structure weaken, just like that higher low we just saw. Then, and only then, do we wait for the price to actually break through the trend line. And finally, for our confirmation, our trigger, we need to see a nice, strong candle close beyond that line. That's what confirms the shift in power from the sellers to the buyers.
And just like with our first strategy, the risk management here is absolutely non-negotiable. Your stop loss goes just on the other side of that broken trend line. And once again, we are targeting a take profit that is 2 times our risk. You have to be consistent with this stuff. It's everything.
Crew, okay, that was a lot, I know. So let's zoom out and see how this all fits together. This next part puts everything we've covered into a simple, clear blueprint that you can actually use.
And here it is, side by side, your trading cheat sheet. For the confirmed bounce, we are playing with the existing trend. The setup is the price hitting our zone, and the signal is that stochastic cross. For the true breakout, we're doing the opposite. We're anticipating a change in trend. So the setup is seeing the trend structure weaken first, and our signal is that strong candle close beyond the line. 2 totally different market scenarios, 2 clear, rule-based strategies to handle them.
So there you have it, a professional framework for trading trend lines. You are no longer guessing whether you should buy a bounce or sell a break. Now you have a specific checklist for each scenario. So the only question left is, which one of these powerful strategies are you going to start testing first? Are you going to be a trend follower with the bounce or a trend breaker with the breakout?